Hi dear traders! Last trading week was full of important events. Investors were assessing the changes in the key interest rates by the US Federal Reserve and other central banks. Besides, traders were keeping in mind the threat of a global recession. Find out how these events influenced the foreign exchange and commodities markets. After volatile trading throughout the week, the US dollar index closed the session at the level where it started, at 104.85. Market sentiment changed sharply on Wednesday as the Fed raised the rate by 50 basis points to 4.5%. Moreover, the US regulator announced a final target of 5.1% in 2023, which is way above the level that was previously discussed. This allowed the US dollar to resume its rise, although at a very slow pace. Market participants fear that while curbing inflation, higher interest rates may hurt the economy. Such worries were confirmed by the Business Activity Index for December, which came out below the forecast. In the course of the week, investors also digested the results of the ECB meeting. Following the lead of its American counterpart, the European regulator slowed down the rate hiking cycle to 50 basis points from 75. But this change was enough to push the euro-dollar quote to a 6-month high. The Eurozone economy is more vulnerable, meaning that high rates will be damaging to it, so a slower than expected rate hike was a positive factor for the market. Meanwhile, the pound sterling faced a different reaction. The UK regulator also raised the rate by 50 basis points instead of 75. Yet, this dovish move by the Bank of England caused a sell-off in the pound. Market participants also took into account the fact that inflation rate in the UK had finally retreated from a 41-year high and that wages increased. All this meant that the Bank of England could have maintained the rate at the current level. As a result, the pound sterling eased under pressure from a strengthening US dollar. The Japanese yen was also influenced by a stronger greenback. Throughout the week, the dollar-yen pair was testing the resistance level of 138. Meanwhile, the Bank of Japan continues to pursue its ultra-loose monetary policy. Suddenly, the Japanese currency got support from the news that a new governor of the central bank will be appointed next year. Mana Nakazora, the chief credit strategist at BNP Paribas Japan, suggested that interest rates should be raised or lowered based on the country's economic performance rather than inflation. In the meantime, commodities markets were trading mixed last week. Gold was following the US dollar and managed to hold at the opening levels of the last trading week. Right after the Fed had announced its decision on interest rates, the precious metal dropped from its previous high of $1,820 per troy ounce. However, this trend changed by the end of the week and gold returned to the bull market. The situation with oil was completely different as Brent closed last week with a decline. The downtrend developed on resumed fears of a global recession. Thus, the preliminary estimates of business activity indices showed that industrial production in most developed economies is very weak and is about to enter a negative zone. Even positive news from China about a possible rise in energy demand could not offset recession fears. By the end of the week, oil was trading at the level of $77.50 per barrel. These are the trends of the last trading week, and now a new week and new portion of macro data are ahead. Do not miss our daily news reports to be always in touch with the latest events. See you!